Hi guys, welcome back to the channel. So I hope you're all doing really well. In this video I'm going to be discussing how to invest into the stock market as a beginner. As you may know, the stock market is a great way to try and build your wealth and eventually achieve financial freedom, which is the end goal. And in this video and in the couple of videos after, I'm going to be going through with you step by step how to invest, how to pick the right stocks, how to make investing work for you, etc, etc. So without further ado, let's go right over to the whiteboard and I can go through how to start investing. So how do we actually start our investing journeys? So first of all, we need to open an account with a trading platform. So a trading platform is a platform where you can buy and sell shares, so shares are exchanged over the counter. Examples of some trading platforms in the UK, there's Trading 212 or eToro. I'd recommend Trading 212 as a beginner, and if you sign up using the link in the description below, you get a free stock, so worth up to £100 when you deposit £1. If you're in America, you can use Robinhood or TD Ameritrade. Both are viable options that are easy to use and simple for beginners. Next step is to deposit some money. So this can be £100, £1,000, £10,000, any amount that you're comfortable with investing. So that would be the second step after creating your account. And step 3 would just be to invest. And I'm just going to go over how we can invest. So you've signed up, you've got your free stock from the description below, and now what do you do? So first of all, what I'd say is plan what you want to do. So are you investing in the long term in companies that you yourself believe in, or do you just want money to come in passively without you really doing anything? So the two types are ETFs or individuals. Now each has their pros and cons. So ETFs are basically the entire market pretty much. So for example, there are some ETFs that mirror the S&P 500. So that's the 500 biggest companies in the US. You can have ETFs for the UK, Japan, France, anywhere you want, which basically mirror the entire market. So if the stock market goes up, your ETF goes up. If the stock market goes down, your ETF goes down. So they mirror the entire market, so you're not really reliant on any one company or another. You're just basically buying the entire thing. Individual stocks, you're buying select companies. This may be Apple, Microsoft, Tesla. You're picking the companies yourself by doing your own training. You're doing your own research on stocks. So you're selecting your own companies, and in ETFs you're selecting the entire market. And so ETFs are pretty much passive, because you can just buy the ETF, put in maybe £100 a month constantly, and it grows without you having to really do anything. Individual stocks, you can have them passively, but I'd say it's very important to keep on top. If some groundbreaking news happens on the company or a disaster strikes in the company, you need to make sure you're on top of that. So it's active. You need to be constantly researching the companies, looking at earnings, reading research reports. So examples of ETFs are, these two are my personal favorites, VU and QQQ. These two are American. They follow the American stock market. The VU follows the S&P 500, and QQQ follows the Nasdaq, which is basically a collection of tech stocks, and the S&P 500 is the 500 the biggest companies in the US. Individual stocks, if you'd have to ask me, I'd say as a beginner, buy things like Facebook, Microsoft, the big giant, Amazon, And once you get more experience with investing, you can pick your own stocks, you can learn how to research, and then pick your own portfolio. So one more thing, and I'll just give you a couple of tips when you're investing. So now you've chosen whether you're going to be an active or a passive investor. Next, you have to just grow into the mindset of an investor. So an intelligent investor would have a long-term mindset. They would realize that any short-term fluctuations in the market would not really affect them because they're in the market for decades, 20, 30 years. So you need to have a long-term mindset. You need to be patient. You have to realize that the money won't come instantly. It will take time to build and build. And you also have to understand the compound effect. So what the compound effect is that when you keep gradually adding money over time, as time progresses, your money also progresses. So let's say, for example, you invest £1,000 at the beginning into the S&P 500. If you keep on top of it and invest an additional £200 a month constantly over a 30-40 year period, you can possibly retire with over £1 million. And that's based on the average returns of the S&P 500. So by investing over around 40,000, you've come out with £1 million for retirement, and you can live off that comfortably and luxuriously. So an intelligent investor understands the long-term mindset. They have to be patient, and they have to understand the true magic of compound interest. So to end this video, I'm just going to give you a little bit of tips that I've learned during my investing experience, and that should help you as well. So one is, don't put all your eggs in one basket. What I mean by that is, don't just buy one stock and just leave it there. Buy a collection of stocks, 4, 5, 6, even 10 if you're buying individual stocks. And what I'd also say is, don't buy only into one field. So if you're buying stocks, don't just go tech and buy Apple, Microsoft, Google, Tesla. Don't just buy tech stocks only. Buy tech stocks, pharmaceutical stocks, maybe energy stocks. Diversify your portfolio. So if one industry is badly hurt, your portfolio isn't, because you have other industries to pull it forward. So don't put your eggs in one basket. Secondly, don't panic. There was actually a research done in one of the main hedge funds in America, and what they saw was that the portfolios that did really well compared to the other ones that were performing the best were the ones where the person was dead, or where the person forgot they had an account. So what does that tell you? It tells you that human psychology plays a great role in investing. If someone sees that their portfolio is performing badly, they forget about all the research that they did, all the good stuff about the company. They just instantly go away and sell at a loss. What you have to know is, the stock market, in the long term, it always goes up. You might have short-term fluctuations, but in the long term it will go up, and you have to stay patient and ride the course. That's what differentiates the smart investors from the dumb investors. The long-term mindset. Okay, so thank you for watching. I hope you got a lot out of that video and you're able to start your investing journey. Remember, if you're from the UK or Europe, you can sign up to Trading 212 using the link in the description below, and you get a free stock as well, worth up to £100. That's a good bonus. Don't forget to like, subscribe and comment if you have any video ideas or suggestions. Thank you for watching. See you next time.